This is Chapter 5, Video 3. Let's launch. So in today's video, we're going to apply the learning objective, apply basic income provisions to compute gross income. So the exclusion provisions, so Congress allows certain types of exclusions. And again, we're going to kind of talk a little bit about this at the 30,000 level. It's basically to mitigate inequity. Very common one that we're going to see is going to be the municipal bond interest. Okay, so what ends up happening is that when you have a taxpayer that's going to end up, they say, for example, they're looking for investment vehicles. They go to their financial provider and they tell them, hey, look, I've got a way that you can do some investments that you're not going to pay any taxes on this. We're going to invest in some Virginia state bonds. Maybe we're going to invest in some city of Fairfax bonds or county of Fairfax bonds. And then as a result of that, you're going to get a tax-free vehicle in order to be able to do that. Now, that's going to be tax exempt at the federal level, not necessarily at the state level. Now, those examples that I gave you, if you have a Virginia taxpayer, it is going to be exempt to them at the state level. But say, for example, I got a Maryland taxpayer and they invest in Fairfax City bonds. They're not going to be able to get a deduction off of it because the way that Maryland does is that they only give you an exclusion for Maryland stuff. One of the places that is very common around here that there's an exemption regardless of where the location is DC. And that's because DC is a federal district. It's not technically a state. And as a result of which, all of the state and local bond interest that you earn while as a resident of DC, whether it's in California, Texas, South Dakota, whatever, you're going to be able to take it as an exemption on your DC income tax. And so that's something to take into account. Gains on personal residence. So we'll talk. We don't talk about this in this class. It used to be a topic in my class, but this time we decided to 86 it. But basically, you can take gains on the sale of your personal residence. If you're single or head of household, you can do $250,000. Or if you're married filing separate, you can do $250,000. But if you're married filing joint, you can go up $500,000. So if you have a person who bought a home, say they bought it in the 80s for like $120,000, they sell it for $600,000. The delta between those two, which is going to be around $480,000. It's under $500,000. They go ahead and they can waive the gain on that. And you'll have to, and it depends on even if it has to be reported. If your clients get a 1099-S, that's a 1099-S as in Sierra, you're going to have to report the income on Schedule D, but you're going to report the exclusion. There'll be no tax effect. If they don't get a 1099-S, you don't have to report anything. Okay, and that's actually a specific IRS rule that you do. And part of the reason why is because the IRS says, look, they're not looking to deal with this. And in fact, I'll be honest with you, in 20 years, I've never had a situation where I've had to deal with an audit with this. As long as they hit 2 of the last 5 years, good to go. You don't have to worry about it. And like I said, the ownership and use test, you have to have 2 of the last 5 years for ownership and use. You meet it, boom, you got it. Any excessive gain is going to be long-term capital gain. So if you got a person who bought a house, maybe they bought it for $40,000, and all of a sudden it climbs up to about $1 million because, and actually there's a place out in Maryland where they had a farm that used to be in the middle of nowhere, and then basically the city of North Potomac, Rockville, and all those other areas kind of grew up around it. I assume when they bought the farm, it was probably worth next to nothing, and then when they, now it's probably a $4 or $5 million property. They would pay some serious gain if they had to sell it. So that's kind of the way that works. Fringe benefits. So there's going to be certain fringe benefits that are going to be excluded. We call these qualified fringe benefits. So some very common ones are going to be medical and dental coverage. So if I pay $40,000 in health insurance and that $40,000 goes to my 2 or 3 employees that I have here, I pay it, I get a deduction off of it. They don't pick it up in income. Kind of violates that balance sheet that we talked about in a previous video. The great balance sheet gets violated in this case because, but the IRS says, look, and it's actually not the IRS, it's Congress. Congress said, look, we want people to have quality health insurance, and so we're going to do this so that way the companies pay for it, give it to the employee earns it through work, but they don't have to pick it up as tax. So it's actually a really good benefit. If you think about it, I mean, everyone's income would probably go up around $25,000, depending on the size of their family, if they had to actually record this as income. So it's a massive benefit that I call it it's called the ghost benefit, because most people don't even know about it. It's like things they hear about, but they never really deal with it ever. Life insurance coverage up to $50,000 is going to be done that way, and then de minimis small benefits. So, for example, if I buy a $25 gift card to one of my employees, they're not going to ask me to go ahead and throw that in. You could also have small, de minimis benefits. Another example. Another example, actually, there's a common fringe benefit. If I agree to do the tax return for my employees for free, they're not going to ask me to throw that in as income, even though technically they got something of value. But there's going to be it's a qualified employee discount as a result of which, as long as it fits certain qualifications. Here's a list of some common fringe benefits. I'll let you guys review that on your own. It is actually from the textbook. You can take a look at this. Freeze the slide. Look at my silly face for a little while as you take a look at this, and you go ahead and you actually examine this a little bit more in detail. Education-related exclusions. So, as an incentive for taxpayers to participate in higher expenses, certain income funds are going to be qualified or excluded for higher education expenses. For example, if you get a scholarship, you don't have to pick that up in income as long as it's used to pay for tuition, fees, books, and supplies. Anything above and beyond that, taxable income to you. It only applies if the receipt is not required to perform services in exchange. So, for example, when I was a graduate student at Gonzaga University, I used to have to work part-time in the local computer lab in exchange for some of my tuition waiver. That was income to me, and I had to pay taxes on it. Now, luckily, it was dirt nothing, because we don't pay graduate students next to nothing at universities. Therefore, guess what? It wouldn't have counted as tax anyways. But for the most part, as long as it's done, as long as there's no work is required for it, then you don't have to deal with that. Other educational subsidies, taxpayers are allowed to exclude from income for 529. So if you have a 529, it earns a whole bunch of money, but you take the money out and you go to Harvard on it, you don't pay any of the taxes on the earnings and interest off of that, which is actually very useful. I will tell you the truth. This is a major area for audits in the IRS. The IRS will audit this very heavily. So as a result of which, my recommendation always is that when you deal with clients and you got 529s, hey, send me a list of your college expenses just in case the stuff hits the fan. And then we can go ahead, we go back out to the IRS and say, hey, look, we're going to go ahead and we're going to take care of that for you and get that taken care of. Taxpayers can elect to exclude interest on Series EE bonds. So I actually have a video on this on my website for my company on EE bonds. It's if you want to learn a little bit more about it, but basically, if you have Series EE bonds, you take the bonds, you cash them out, you use the proceeds in order to go to college. No big deal. Okay. It's only restricted to taxpayers below certain AGI limits. So obviously, if you're a college student and you cash out the bonds and use it on your own stuff, it's not a big deal. Parents could be a problem. So you want to make sure that you're taking care of that and making sure that gets taken care of. Okay. Exclusions that mitigate double taxation. So there are certain things that they do that they want to prevent this horrid concept of double taxation that sometimes happens. So you may receive property as a gift from a decedent. So what they're going to do is they're not going to tax the gift as income tax, but it falls under the gift tax rules, and so you have to follow that in order to be able to get that taken care of. All right. So while the receipt of promoting property is certainly income, the value of inheritance is excluded as gross income because it will be subject to federal gift and estate taxes. And so life insurance proceeds, amount that's received due to death are excluded from the income of the recipient. This is kind of the thing, and this is going to be, here's the thing, the IRS obviously, they do this. There's several reasons why it happens this way. The majority of the main reason why is because when you buy life insurance, it's not a deductible. You can't get a deduction on paying for life insurance. However, so when you receive the receipts, again, that great balance sheet, if I don't get a deduction for something, don't get a tax benefit as a result. Now, oftentimes what will happen is life insurance is you're obviously receiving more money than you paid into it. And so that actually kind of violates that rule a little bit, but they're kind of looking at this, well, it's death. This is a reason why we're going to kind of exclude it. Now, that's not to suggest that, I mean, I always say, as kind of a joke, we only die once, death is a tax planning strategy. You can only do it one time. And so as a result of which, it's kind of an extreme form of tax planning, but that doesn't mean that we don't help our clients. Like, for example, I have a couple clients that are in their 80s. And as a result of which, as we're talking about their tax situation, we're like, hey, look, we need to do various different things in order to set you up so that when you do pass away and give all these assets to your kids, these are going to be the way these things get treated. So there definitely is some tax strategy that needs to happen. And look, guys, let's be honest. Every one of I had a friend of mine who used to make this joke. He said, "Quit taking life so seriously, Kevin. You're not getting out alive." And there's a lot of truth to that. We have to plan for the fact that at some point we're going to die. As a result of which, how are we going to transfer that stuff to our families? And it was funny when I used to take an estate and tax planning course. I used to give some examples of people who had not done good tax planning. And I'm trying to think of the name of the individual. He was one of the Sopranos stars who died. We actually examined his will, and it turned out, I guess he had given like $10 million to one of his kids, just willy-nilly straight out. Now, the kid was 16 years old, so it went to a trust for them temporarily. But once that kid hits 18 years old, boom, $10 million. I mean, it's how they spend it. I don't know. I'd like to actually follow up and see how the kid's doing, see if they've blown all their money or if they've actually used it wisely. Hopefully they got a good financial planner that's helping them out. But if you're setting up a will that way, I'm kind of thinking you don't have that kind of good strategy already. So you might want to seek out professional advice. This is why I always tell people, make sure if you're, tell your clients, hire a good estate attorney, make sure that you're setting things up correctly so that when things do happen, it moves on. Okay, so exclusion does not generally apply to life insurance policy. It was transferred to another policy for valuable consideration. That's true. So if I sell my life insurance policy to somebody else for $100,000, that exclusion doesn't happen. Okay. The taxpayer cancels the life insurance policy and receives proceeds in excess of premiums paid. That is also taxable income. Accelerated death benefits could be excluded, and then they, and I'm trying to remember what these are called. I used to know that I was working on my license in life insurance, and I can't remember what these are called, but they're basically, you have a terminal disease, you're going to die probably in the next 6 months. You call your life insurance company and say, I'm dealing with cancer treatment, hospice treatment. I need money now. They give you a front on your money with the expectation that you're going to die within the next 6 months. They go ahead and they do it. They charge you a bunch of fees for it, but it can also help out so that when you do die, your kids are not stuck with this huge bill that the hospital's like, pay now, pay now, pay now, pay now, pay now. It kind of helps things out. So there are good reasons to be doing this. Foreign earned income, this is my subject. Okay, so for 2020, maximum amount of $107,600 can be excluded. Okay, a maximum of $15,064 can be excluded for foreign housing. That's actually not 100% accurate. If you live in a high-cost area like Hong Kong, London, or Paris, you might actually have to deal with, you may have a higher number that you can actually qualify for. It's a very rare circumstance. You got to know what you're doing. And if you don't, make sure that you involve somebody who does in order to get that. Another exclusion. Okay, so they talk about this. In order to do that, you have to have your taxable amount. I'm not going to go into this. I could spend an hour talking about this exclusion provision because there's two different tests. There's what we call the PBT, which is the physical presence test, and then the BFE, which is bona fide residence test. Basically, under these two rules, you have to qualify in order to do this. What they're describing up here for number 2 is actually the PBT, and then the first one that they're describing is the bona fide residence exclusion. Okay, so for an example, we'll talk a little bit about this. Considering transfer to an overseas affiliate, it'd be paid to $120,000 annually. Assume a 12-month qualifying period is for 200 days in the first year, 140 days in the next year. How much can be over $65,000 salary can be excluded? This is for a partial year exclusion, and we actually do this all the time here at Beta. I'm not going to go into this because again, I don't. It's probably something you're not going to deal with too much, and if you do deal with it, it's something that's readily accessible. Okay, sickness and injury included related exclusions. So if you have who are sick or injured or reflect their inability to pay tax and facilitate recovery. So there is an exclusion that happens with that. Workers' compensation. Payments from workers' compensation plans are excluded from gross income. Now, that's not unemployment. That is compensation, workers' comp, as they call it. So I remember when I was working at McDonald's way back when I was young, I slipped on some grease and I landed hard on my right knee, very hard. I was limping for like about 2 days. The manager was following me around, said, Kevin, you need to go to a hospital, I'm like, I can't go to a hospital. I don't have any health insurance. There's no way I can afford this, blah, blah, blah. They said, don't worry, we'll pick up the tab because workers' comp was going to help him out. So we went to the hospital. They got x-rays, found out nothing was broken. I just went home and I iced it out. They paid me for a couple days to get back to 100%. Of course, back then I was young and dumb and so full of my head. I was kind of hard-headed. I didn't want to do anything, but the manager really helped me out. And I wish I could go back to that manager and say, thank you very much for doing it. I remember actually I didn't get along with that manager very well, but after that we actually got along pretty well because, I realized that she was a very, very nice person who really did care about people. Okay. So then there's payments associated with personal injury. So if you sue somebody as a result, so if say you get into a car accident, you sue them and you receive money as a result of physical injury or medical costs, they are excluded. If you have punitive damages, however, they are fully taxable. So if I sue somebody, say they did a lot of damage to me, and I said, look, I'm going to hit you for personal injury, I'm going to hit you for my medical expenses, and then on top of that, I've lost $80,000 of salary. That $80,000, and if I win, I get the $80,000 bucks. That $80,000 is totally taxable, and you do have to pay tax on it. Income tax only, though, not social tax, because the way that gets done. So healthcare reimbursement. Reimbursements by health and accidents insurance policies for medical expenses paid by the taxpayer are excluded from gross income. So for, that way, if your employer pays for those things out, they can be excluded if it meets certain criteria and conditions. Disability insurance, also called wage replacement insurance. If an individual purchases disability insurance directly, any disability benefits are excluded. If the individual purchases the disability insurance and the individual excludes the death benefit from their compensation, then it's taxable. This is important. I get a lot of people who are, like I have one client who's actually on third-party sick. She was under the impression it wasn't taxable. We actually did some digging on this, found out it was taxable, and unfortunately, she got a surprise bill at the end of the year. But we solved it. It did happen. All right. So another deferral provision allows taxpayers to defer but not permanently exclude the recognition of certain types of income, and there are going to be some examples. Installment sales. Obviously, you don't receive the cash up front, so as you receive the cash, you're going to get some gains on it. And then you have involuntary conversion. So, for example, I have my house, hurricane blows it down, I have to rebuild the house. They're not going to tax me as a gain for the conversion and buying of the new house. Usually what will end up happening in those cases is you'll just get a basis reduction, and then you get a basis increase as you rebuild the house. So it ends up working out, tit for tat in that sense. But the insurance proceeds handed to you to rebuild that house are not going to be taxable to you as income. You have like-kind exchanges, and then contributions to non-Roth qualified retirement plans. That's going to be like your 401ks. Also your traditional IRAs. If you're under certain income limits, you're going to be able to get a deduction for that. Okay, that's all I've got to say about all this. I want to say thank you very much, and I'm looking forward to seeing you at the next video.